All right, so I'll talk about my background a bit. So as Albert mentioned, Albert's a good friend of mine, been a friend of mine for a while. And we do have this Thursday dinner that he talked about. It's really great. We've got a lot of really great people at it. And it's really great to be the smallest person in the room. I try to force myself to be that way all the time. And I put my friends in that position too. So it's really good. So you guys should practice that as well. Try to be the smallest person in the room. Most coachable, one always wins. So some of my background, I've been around for a bit. I'm 47. I have really good doctors. I look 32. So that's how I got my girlfriend. You know? Anyhow, so I started my career in the mid-90s in the Silicon Valley. And there was this thing called the dot-com boom. A lot of you probably don't remember that because you're really young. But I started my career back then. And then I was part of a bunch of companies. A few of them did really well. One of them was called lowermybills.com. We sold that company to Experian. I was one of the original guys there. And through that business, I started a credit repair agency about 18 years ago as well. It's called Erase.la, and we deal with consumer credit, and that's really growing, and it's a great business, especially in times like this when you have a bunch of, like really strange things happening in the economy. Your rates are really high. People are defaulting. It's really crazy. And then we started a company called MySpace. I was there at its inception. Yes, Tom is a real person, and he was my real best friend for over 20 years. Yeah, he's a real dude, and he doesn't wear that white t-shirt anymore, and he's got a beard. He looks totally different. So we talk like 20 times a day and stuff. He's a great guy. And during the MySpace time, it was a really interesting business. We started it, and 18 months later, we sold it to News Corp. And we were kind of there until 2008, ending our earn out, and then we left. I started a company in 2009 to service MySpace. MySpace had a unique problem. It had too many ads. It had 7 billion ads per day, and they're going under-monetized. The web has never seen traffic like this before at that time. We were actually bigger than Google at one point in traffic. So I had to build a solution to deal with that challenge, and I built a company. It was an ad network. It was called Engage BDR. Built that company in 2009 to service MySpace, and then quickly within the first few months ended up servicing top 500 publishers on the web, companies like CNN and weather.com and et cetera. So took that company public in 2017 in an IPO, and then during that time made some investments in a bunch of different companies, and another one we took public in parallel around the same time as well. So I have some experience in public equity, private equity, taking companies public, a variety of different things. So today, Albert, this is like, if this is not relevant to you, you take it up with Albert because it's his fault. He told me that I should talk about this kind of stuff, and he says it'll be really interesting for people. So if it's not interesting, you can find Albert and deal with him on the side. So factoring. So I'm talking about growth capital today. Growth capital is very different than asset-based lending. A lot of you people are probably in real estate as well. I am too. I have a short-term rental portfolio. I've owned properties around LA and do a variety of different things with them. But in that world, you're used to asset-based lending. So we're not talking about that right now. We're really just talking about growth capital for companies, taking them public, raising capital, things like that. Factoring is one of them. When you have receivables, if it's a consumer-based company, you're selling basically to consumers, and you have recurring revenue streams, you can leverage asset-based lending. So essentially, factoring is taking your receivables, pledging them, you had a UCC filing against your company, and then you can borrow against the future receivables of that. And that usually is a lot cheaper than taking out, an equity investor or other types of debt. Term debt is pretty typical. It's like, you have a loan or a line of credit, stuff you get from bank, and it's based on your financials, based on your tax returns, a variety of different things. That's typically what term debt is. And from that standpoint, you can decide what's cheaper for you. If is it going to be something like that, or is it factoring? Lines of credit are very, very similar to term debt, but it's like a line you can draw down against it. And a lot of it is based on your financials and also assets on your balance sheet. We'll start talking about balance sheet and stuff like that subsequently in other slides, but the stuff that's sitting on your balance sheet is assets. You have receivables and other assets like hard assets, even cash. You basically borrow against that. Cash flow leverage, this is becoming really hot right now. If you've got a business that has really strong deposits every month, so for example, I'll give you an example. We have a short-term rental business that does about $500,000 a month in receivables right now. It's on its way up. It's pretty new. It's growing. That business qualifies for a real quick couple months worth of revenue, really fast. These guys out there right now are doing these types of loans. They look at your bank statements and they'll give you a couple months worth of your revenue up front and then basically break it into 12 to 36 month payback terms. And it's pretty expensive, but sometimes you just need that cash and it works pretty well. That's a really hot area right now in lending for these types of private companies. Convertible instruments, and we talk about this in what you're probably used to hearing is safe notes and convertible, debt, convertible notes, etc. So it's basically starts off as debt with some sort of repayment instrument, and then eventually it'll convert into equity if you hit some sort of a trigger, and the trigger can be time or it could be some sort of performance metric. It could be revenue figure, it could be profitability, it could be whatever it is. Or it could be reverse. So if you hit some sort of milestone from a negative standpoint, so if you breach some sort of covenant, or if you breach some sort of cash on hand or whatever it is, then they can convert. So it's a variety of different ways. And then private equity, which is these PE firms out there, they'll put money into companies based on their profitability or their EBITDA, which is a very typical measurement of success for a company. EBITDA is great because it removes all your accounting tricks, depreciation, amortization, finance costs, things like that, and they'll just kind of give you the kind of cash flow value of what the company has, cash flowing. And that, leveraging that, if you've got strong EBITDA percentage to revenue, then private equity firms will do really well for you from that standpoint. But they're a bit risk averse, so they're expensive. From an equity standpoint, they're going to take a lot more equity than you probably want to give them. And then public equity, which I'm going to talk about as well, is taking companies public. The different formats. Taking a company public just feels like a really big thing. An undertaking feels really big, but it's really not. I've done it 2.5 times, and it is actually very, very simple. So I talk about this a lot, and I put Albert in this place all the time. It's like, hey, Albert, I know you're a big dude. You're the biggest Mexican dude in Bel Air, right? He's like the Mexican Prince of Bel Air. And he's like, he's like this huge, guy. It's like, yo. And Albert, but I'm like, yo, Albert, I want you to be the smallest dude at this table, So I put him in front of like all these people, right, which are like, really smart, and they've done really, really great things. And I try to facilitate this. I've been doing this for 4 years, and this dinner every Thursday. And there's 12 guys, there's 80 guys in my dinner club, and every one of them are like, every one of them are 800-pound gorilla, right? They're really, really great at what they do. Super coachable, no egos, no arrogance, nothing like that. Really nice guys. So I've been exposed to that kind of energy and environment for a really long time. I've always been around people like this, and that's kind of what I've done best. That's my only true talent. I can't paint, I can't draw, I can't fucking play an instrument, but I know how to get around good people, and that's just really, truly my only value. So I was around this guy. This guy's name is Robbie Lee, right? Robbie Lee is this really, really great guy. He's a Korean Jew. He's super racist, but I think he just does that to be funny. And I've never met a Korean Jew before him, but it was fantastic. Anyways, the guy did something really miraculous. So I found a way to get to him because he needed some value as well. He wanted, he needed a marketing arm for a new venture. And I was the guy, and I came really highly recommended. So I presented some value to him, and then I got to be around Robbie Lee. Robbie Lee, being around him, the osmosis changed my life. And what that really did was he was able to take several companies public over the years, and he did it without any cash. And I was like, how do you do that? That was really interesting and really crazy. And so he started talking to me and showed me how he did it. He started selling dreams. He was selling these dreams to people. He took a private company with no revenue, just a shell, started acquiring mom and pop dry cleaning operations around the country with no cash, buying these mom and pop dry cleaning operations, and just issuing private paper, meaning equity in a private company. Company that did not even have, was not trading, there was no registration statement filed, no S1, nothing. It was just private. He sold them a dream, and the dream he sold them was, look, I'm out here trying to build the biggest dry cleaning roll-up in history, and I'm gonna take it public and all of us are gonna win. And that's exactly what he did. He built the biggest dry cleaning roll-up in history with no cash, and he exited, and it was a 10-figure exit, and it was huge. And so I didn't think any of this was possible. I didn't have any of these ideas. I was like, what the fuck are you talking about? This is insane, right? And so by me being around Robbie Lee, I was able to do it myself. And there's an LA Times article that said that I was on a $100 million acquisition rampage. This was like in 2015, acquiring media companies. And I was doing that in 2015, 2014. And what the LA Times didn't write was how much cash I was spending to do it. I didn't spend $1. I had Robbie Lee in my corner showing me how to do it. I bought these companies with no cash. I gave them equity in my privately held company, sold them a dream, and they bought that dream, and then I took my thing public. And I had guys like Robbie Lee showing me how to do it. So taking a company public is not as hard as you think. It's as easy as knowing someone that did it. And Tony Robbins taught me this shit when I was a fucking kid. That you want to do something, you find someone who's already done it and you replicate it. That you dream as big as you want, and if you can find the person that has done it, they're gonna show you how to do it. So that's the thing, you know? It's like we always wanna add value to people's lives. I'll show anyone in this room how to do it. I just wanna feel fulfillment. That's the best, you know, best achievement for me is to be able to do something for someone else as opposed to doing shit for me. I don't really get that much fulfillment buying, you know, shit for myself or doing a lot of stuff. But if I could show you how to do something, we could both win, you know? So anyway, so taking companies public is not that hard. Just gotta understand how to do it, like understand the steps. You could do it as, you know, in as quick as like 90 to 120 days if you really set yourself up to do it. And so that's that big part. So as far as valuations and multiples on your company, it's gonna be based on the public comps. It's always based on public comps. So look at the sector that you're in and then look at the market and see what that company is worth. Look at the revenue multiple or an EBITDA multiple of EBITDA, multiple of earnings or revenue, right? Could be a mix of the two, and then you can understand like what your company is worth, you know, from that standpoint. Take apart their balance sheet, look what's on their balance sheet, look at their financials, look at all that stuff, and you can get an idea of what your company is gonna be worth. So based on something like that, I actually, when I took my company public, my first one, I took a company public in Australia. And the reason why I did that was because the valuations here, there were only 2 companies in my space, my sector here in the US that were trading publicly. Unfortunately, they both shit the bed really bad. One of them was trading at 0.1 times revenue, like a tenth of revenue. So if you had $100 million in revenue, it was worth $10 million. And I said, you know what? I spent 2 years trying to get ready to go public, and I'm not gonna list here because it makes no sense for me. So then I took it to Australia, and they gave me a valuation that made sense for me. You know, it was like 5 times revenue or something like that, which is fantastic. And they had no comps on that exchange, just basically what they're willing to buy. So it worked out. So from a valuation standpoint, you could understand what is right for you, and you figure that out. And I'm also here to help. So you guys can reach out to me. There's my Instagram right there. So profit versus paying less taxes. So this is kind of interesting because we have a lot of people in this room who have businesses that don't like paying taxes. Like I don't like paying taxes either. And you know, it's one of those things where it's like, you got to decide what you want to do. Look at tomorrow, look at the future. You want to build a business that you can sell, then you got to show profitability. Fuck the taxes, but show the profitability, right? Showing profitability does not mean that you have to pay taxes. Showing profitability means that you're ready to show scale and you're not expensing down your income. So a lot of people are like, yeah, let's create as many expenses as we can so we have to pay less taxes, and you're really sabotaging your future, because at the end of the day, you can use depreciation and amortization and finance costs and all this other stuff to reduce your income post bottom line, so you don't have to pay the taxes. You could do it a different way. But you have to show the true performance of the business to be able to get to raise capital, to be able to take a company public, et cetera. You have to show strong financials. And then another thing which is really interesting is like building appropriate sized accounting teams. So accounting team for $10 million revenue company, you need a handful of people. You need like 3 people, 4 people, 5 people. But these people are going to be very specific. They have degrees in accounting. They might even have a CPA license. And they have specific amount of experience and background. They've been in the business. They've been in this business specifically, whatever that business is. They've been in accounting for a number of years. And when I say a degree, I mean a degree in accounting, right? That's really important. You're going to hire junior accountants. You're going to hire senior accountants. You're going to hire AP, AR specialists, controllers. You're going to have these kind of people. Do you need a CFO at that point? You don't really need a CFO. You just need the army. You need the soldiers. And it's really critical. You need accountability in your business. You need predictability, right? So predictability, what that really means is you need to be able to forecast revenue. You need to be able to forecast profitability down to the week. You know what you're expecting in terms of revenue. You know what you're expecting in terms of any pitfalls that are coming. You need to see them a mile away. You can't do that without financial reporting and analysis. So that's different than accounting, but you need that. And as I mentioned, real accounting roles, you need an AP specialist. I mean, depending on your size of revenue, you could have one person do both, AP, AR, reporting, and a controller, but you need controls in place. You can't have a bookkeeper doing all this stuff. Say no to bookkeepers. So everyone's got this like bookkeeper / tax person that's been doing their shit for like years, and there's just like this 65-year-old dude, and I mean, they're nice people, but not maybe for your personal taxes and stuff like that, it's good, but not if you're trying to build an enterprise. No, just say no to bookkeepers, no bookkeepers. And then scalability. So whatever you do, and I have this analogy. So you guys are probably, some of you not, are familiar with this designer. Fastest growing men's designer in history. His name is Mike Amiri. Mike Amiri has been one of my best friends for 20 years. Him and I started a business together when he was in the middle of fashion. He had a fashion brand called Jaded by Night. Put that on hold, shut it down because he had a fallout with his partner. Came to me and said, bro, what am I gonna do? I don't wanna do fashion anymore. Let's do something together. I said, I'd love to do something with you. You're one of the smartest guys I know. Let's figure it out. So we started a supplement business with David Rivera was our supplier. He's in this room. There he is, right there. David Rivera remembers this. Him and I go back like 18 years. We've seen a lot. We've spent millions of dollars with each other every month for a long time, this guy. Anyways, so Mike Amiri and I went off on this voyage of like, hey, let's start a supplement business. What are we gonna do? And of course, Mike's like the king of perceived value. He's like, I'm gonna make glass bottles and wooden boxes to make look like iPhone boxes, and like really crazy because everything he does just looks super expensive and elegant. So we did that. We were doing that and it really did well. We did $24 million the first year, doubled revenue every year for 4 years and crushed it. And then he got to the point where he's like, oh, I'm gonna start another fashion brand. I'm inspired now, let's do it. So he started a brand. It was called Michael Amiri, did a capsule collection for Maxfield, and he sold out in one day. And then that was the beginning of Amiri. And then now Amiri is like doing multi-billion dollars in revenue. He's put a store next to every Saint Laurent and just shit on them. And he's taking their men's business. It's insane. He's crushing. So what he learned is we try to do everything scalable. If we don't want to be in a business that is not scalable, that has scalability limitations. We want to do something that's scalable that we can grow. We want to be in a business that can grow, that can run itself. We don't want to be managing a business every single day. We don't want to be, what are we in the business for? I was having this conversation outside earlier today too. It's like, don't lose track of your core values. Like, what is most important to you? Why do you want to start a business? At the end of the day, you want to start a business so you can have freedom, right? That's the end of it, right? Freedom. So you're not working for somebody, you're able to do whatever you want to do. So you want to build, scalability technically means that you're scaling away from yourself and you have people running your business and it's doing, it's able to grow continuously. You don't see a limitation. It's able to continue to scale. So Mike did the same thing with fashion, because everything we learned together, he applied in fashion. He's like, how do you build this business? He's making these jeans, they're like $2,000 each, and they got these people with like Dremel tools and shit, like doing building these like pants and jeans and shirts, and they got shotguns, they're shooting at the shirts, crazy stuff. Like, how do you scale that, right? But he figured it out. He scaled it and he crushed that business. So if Mike can scale like a couture fashion brand, we can scale anything, right? So you got to think about scale. Like, whatever you're doing today, can you get it to real scale? If you don't think so, then you need to talk to some people that can help you figure that out before you keep going. Because without scale, it's just, you don't want to run a small business forever, Because a small business and no business, there's not much of a gap, right? That business should just go away. So you need room for failure. So some of the stuff that I talked about when you're getting ready to raise money, take a company public, bring on an equity partner, even bring on somebody who's really like a David Rivero, like let's get him on the board. He'd be a great guy to have on the board. They want to see this stuff. People want to see it. You want to attract any real talent? They want to see this stuff. So quality of earnings report, that's a Q of E, right? Essentially what that is, that's just like the fundamental thing that an auditor will do. Look at your financials. They won't sign off on it. They'll look at your financials. They'll create this report and say, this has been reviewed by us and everything looks okay, right? But that's about it. That's the baseline. That's the minimum you're going to need to raise any capital. From a private investor, a public investor, whatever, anything. That's all you. That's the minimum you're going to need. Now, investors are going to ask for more stuff too. The next level is called a review. So, when an auditor does a review on your company, your financials, they're just looking at your financials, and it's generally 3 years. By the way, it's 3 years of earnings, and they look at it and they review it and make sure it's fine. There's gonna be some adjustments they gotta make. They're gonna go back and forth. You're gonna find some things that you're surprised about, good and bad. You should be doing reviews every year anyways. So that's the next tier of stuff. So a private investor, you have some sort of business, trying to raise some money, you have a deck that somebody on Fiverr made for you, and then you have and then you have this review, right? Like, we have a review, so we're pretty legitimate. Our financials are real. They're not like invented or not like somebody bookkeeper made them for us. That'd be the baseline. The real accountability comes from audits, right? You get an audit, and the audit is painful the first time, and you do this audit. And you feel like you fucking won NASCAR because at the end of it, because it's a lot, man. It's a lot, And when you do finish the audit, you're ready for the next one and the next one, because you're going to do them every year. You're just going to continue to do them. You're going to do them every year. And when you do your audit the first time, the audit is like the highest level, right? And then below that is review, and then below that is quality of earnings, right? So you can just skip all the bullshit and just go straight to an audit. Preparing for an audit takes a long time. You have to have a lot of procedures and policies and stuff like that in place, but it's not hard. Now, if you're in your first year of financials, like your first year, that's the best time. After the first year is done, do an audit, because you have, all the framework can be built from there. You could take a company public after the first year. It's so easy because you only need that 1 year of financials. You don't need 3. Generally, you need 3 years audited financials. So a lot of stuff can come out of an audit, which is really interesting. Like for me, I found a lot of money in the audits every year. What I mean is I found revenue that wasn't recognized. I found prepayments from clients, from David Rivera. He prepaid me $100,000 for something. He totally forgot about it. I found it. But in my contracts, I had that I could recognize it as revenue within 6 months if he didn't spend it. Stuff like that. So, you'll figure out things. You'll find prepayments that are sitting on the balance sheet as a liability. But after a certain amount of time, you can move that prepayment to a revenue. You can recognize it as revenue after a certain amount of time. So it turns into revenue, not a liability anymore. Things like that. You'll find expenses are double counted. Things like that, so your bottom line improves, and then other stuff that your partners have been using your credit cards and, paying for David Rivera's house parties. He has crazy parties, this guy. It's pretty insane. And you find out all that stuff, it's really important. Keep everyone accountable. That's where your audits are. Now, as far as SEC filings, I've done registration statements in the past. I've done multiple kinds. I've done an S1, and S1 is where you raise capital and list the company at the same time. So the listing is contingent to the capital raise, and essentially they're both hand in hand. So the S1 registration statement is kind of like the one that everyone kind of goes to. It's like the marquee registration statement. The second one, which I prefer actually, is when you don't have to raise any money and you actually just list the company. You just do a listing straight up. No capital raise, super fast, and it's listed. You can do that within 60 days. And that is a lot easier than you guys think. Everyone's thinking like, oh, NASDAQ, it's fucking crazy. They're ringing bells and, you're in New York and all this stuff, right? Well, yeah, you are ringing bells and you are in New York, but the listing a company without raising the capital, you can do it on, and you could actually raise the capital this way too, but you could do it on the exchange called NASDAQ Capital Markets. So it's called NASDAQ CM. And it's an alternative to the OTC, which is over the counter, OTC. Pink Sheets, Wolf of Wall Street. Hey, how come we didn't have Jordan speak? That would have been good. Anyway, so OTC is like they call the Pink Sheets. It's a smaller tier exchange in the US, but a good alternative is the NASDAQ Capital Markets. And that market is really strong. In fact, it's so strong that the buyer of these shares has no idea that it's a NASDAQ Capital Markets stock or a NASDAQ stock. There's no real difference between the two. So it's just on the NASDAQ, period. So you could list on the NASDAQ real fast. You could do it in like 60 to 90 days. It's pretty quick. I know how to do all this stuff. I've already done it. So if you have questions, just hit me up. So who did the most, I think the most recent one that I remember was that crypto exchange. What was it called? Who did direct? Did they do a direct listing? FTX? I think they raised cash. Yeah, but there was a crypto exchange a little while back. With one of the biggest ones. I can't remember what. Coinbase, yeah. Coinbase did a direct listing on the NASDAQ without any capital raise. And that was really interesting that they did that. They had enough cash. They didn't need it. They just wanted to be trading. So there's a lot of benefit to being public. And as I mentioned about the whole Robbie Lee thing when I was talking about like selling dreams and buying shit with private equity, meaning no public traded stock, just like your LLC that you have right now, your Montana LLC where you register your cars like I do, that one, you can use those shares to buy companies, right? You can do that. But how about this even a little bit more crazier, a little bit more, a little less harder, taking your public vehicle, you just listed your company, you're just trading now. Now you can issue shares to buy anything you want because it's a currency now, right? Because it has a public valuation. These shares are worth something and you can see what it's worth on that ticker every day. It changes every day. So you can you can issue as many of those shares as you want and you can use them to buy shit. Buy your competitors, all of them, or some of them. So I'm saying like raising cash is one target for a lot of people. They want to be able to figure out how to raise money, but what if you don't even have to raise money? What if you don't want to raise money? You just want to use the currency to buy stuff, right? And attract the best employees too, because you can give them stock options and all this other stuff, and it's liquid, meaning it's instant. Now, raising capital when you're public is very different than raising capital when you're private. Raising capital when you're private, what do? You get on this fucking roadshow, you're wearing a blue suit, you've got this deck that the guys on Fiverr made you, and you're just like out there trying to sell your company. We're the best, this is what we do, and all this stuff, and I gotta sell you, and there's a 30-minute presentation, and all these slides, and all this stuff, like every single time you're raising money, right? And you gotta do that a lot. That's what raising capital on the private side looks like. Now, raising capital on the public side, here's what I would do. I'd tell my broker, hey, we need to raise $10 million. What's the discount? Broker says, 15%. Cool. 5 hours later, it's done.